미국에 이어 세계 각국이 금리 인상 대열에 동참하면서 증시가 흔들리고 있는데요. 인플레이션의 정점을 지났는지 여부도 논란이 있는 가운데 기업들의 실적 발표도 이어지고 있습니다. 이런 상황에서 개인 투자자들은 어떤 투자 전략을 세워야 할까? 이런 질문에 답을 얻기 위해서 화폐 전쟁, 신대공황의 저자로 잘 알려진 미국 최고의 통화제도 분석가이자 미국 국방부 국제경제자문위원인 제임스 리카즈를 저희가 만나봤습니다. Hello, this is Jiho Lee. Welcome back to Talks with Global Guru today. My guest today is a lawyer and an economist and an investment banker and a multiple New York Times bestselling author. He's also one of our favorites. Please welcome back Jim Rickards. Nice to see you.
Thank you. It's nice to be with you.
Let's talk about currency first. There were many voices predicting the decline of the dollar era, such as the movement to introduce CBDCs in major countries and the Bitcoin craze. However, as the dollar index crossed 100, would you say the dollar is developing a super strength phenomenon? As a currency expert, what economic impact might be expected?
Right. Well, there's a lot of confusion about the value of the dollar because people don't know how to measure it. If I asked you to measure a football field, and let's say I sent two people and one had a 1 meter stick and one had a 1 foot stick, they'd come back with different numbers because they're using different measuring sticks. So here's the problem. When people talk about a strong dollar or a weak dollar, they look at a dollar index. There's the Bloomberg dollar index, there's DXY, there's our Federal Reserve Bank, our central bank has a weighted dollar index. So there are many indices that you can look at, but they all compare currency to currency, and they do it on a trade weighted basis. So frequently the euro is the biggest comparison, but not the only one. You could have South Korean won, Japanese yen, Swiss francs, euros, but typically the euro is the largest component because the dollar euro trading relationship is so big. And so when people say that it's a strong dollar, it's really saying it's strong compared to the euro and the yen, or a weak dollar, it's weak compared to the euro and the yen. But that's not the right way to do it. And the reason I say, you can do it for trading purposes, and it's important if you're an importer or an exporter, those relationships do matter. But the only way to measure the value of the dollar without using other currencies is to look at gold. And I'm not saying we have to have a gold standard. I'm not a gold bug, but I am saying that the dollar value of gold is the right way to measure the dollar. And the reason is that gold is not issued by a central bank. It's not a central bank command currency. So all the currencies have the same problems. You can say that the dollar is strong against the euro, or the dollar is strong against the index, or maybe it's weak against the index, but all those currencies are in the same boat. It's like two passengers on the Titanic arguing about who has a nicer cabin. Well, that's fine, but they're all going to sink together. And so the point being, all those currencies are going to maintain some strength as reserve currencies and payment currencies, or they're going to sink together. So how do you know if they're all doing well or not? And in particular, if the dollar is doing well or not? The way to do that is to look at the dollar value of gold. So right now, the dollar has been getting weaker almost every day because the dollar value of gold is going up. For about 18 months, from late 2020 until early 2021, gold was in a narrow range of between $1,700 and $1,900 per ounce, but mostly around $1,800 an ounce. In the past 2 months, it's broken out. It's now closer to $2,000 an ounce, not quite. But right, I think today I looked at it, it was $1,950 an ounce. So that tells you the dollar is getting weaker measured by gold, even if it gets stronger measured by the index. And that's how you can reconcile those two things.
Since the dollar and gold are in competition, they usually show opposite movement, but recently the dollar and gold prices are rising together. How would you explain this relatively unique occurrence?
Well, I would just offer the same explanation I just gave, which is gold is going up. That means the dollar is going down. But then you say, well, the dollar is going up. Well, it is, but only compared to other currencies. So the way to think about it is if you're comparing the dollar to the euro, the Swiss franc, and the Japanese yen, the dollar is going up. You're correct. But if you compare it to gold, gold's going up, which means the dollar is going down. So the way to reconcile that is to understand that among all the currencies, the dollar is stronger. But compared to gold, all of the currencies are weaker. Because when you say the dollar price of gold is going up, that's true. But so is the euro price of gold, the Swiss franc price of gold. Gold's going up in all of those currencies. The dollar is going up against the other currencies. So again, the conundrum or the confusion comes from the fact that you're using different measuring sticks. So the way I would describe it, Julio, is the dollar is getting stronger relative to other currencies. That's true. But gold is getting stronger relative to the dollar, which means that all the currencies are really getting weaker.
The world is now entering the endemic era where the pandemic is slowly being contained. At the same time, the Russia-Ukraine crisis is further taking a toll on the world economy by delaying the restoration of the global supply chain. What impact will this conflict have on the global economy and especially for the stock market?
Well, I like to break that into two parts. One is what's going on with the pandemic, and then we'll talk about the war in Ukraine, the economic sanctions, and the supply chain.
Okay.
It's true that the pandemic is fading in most of the world, and that's a good thing. Obviously, in Korea, Japan, the United States, Europe, Australia, elsewhere, the new cases are on a very sharp decline. The pandemic seems to be under control, pretty much going away. That is not true in China. China has some major outbreaks, and it's getting worse in China. And we've seen extreme reaction to this. For example, the Communist Party of China has shut down the city of Shanghai. That's today. That's not a year ago or 6 months ago. That's happening right now. Shanghai has 26 million people. It's by far the largest city in China. It's also one of the very largest cities in the world. But the whole city is under lockdown. There are curfews. You're confined to your house. You're not allowed to go out except for food and water, but even that is scarce. Some people are complaining that they can't get any food or water, industry shut down, etc. This is part of China's zero COVID policy. The zero COVID policy is one of the dumbest ideas in the history of public health because it cannot possibly work. It's like saying zero colds, we're going to make it illegal to get a cold. Well, sorry, people are going to get colds. They always do. And people are going to get COVID. The vaccines do not stop the spread of the disease. They do reduce symptoms in some cases, and they do probably reduce fatalities among the most vulnerable population, but they don't stop the infections and they don't stop the spread. Masks don't work. Everyone wears masks, but they don't work. It's sort of for show. If you want to do it, that's fine, but they don't work. None of these things work. The only thing that does work is what's called herd immunity, which is simply the case that if enough people get the disease, remember, this is not highly fatal. It is fatal in some cases, and that's sad for those individual cases. But on the whole, it's not that fatal, and it's been getting weaker as it goes along. So it's kind of like the flu, maybe not even that bad. I know many people who've had it, friends, family members, and they all say the same thing. It's 2 days. It's a little uncomfortable, maybe a headache or stay in bed one day, but then it's over. And in fact, when you get it and you come through it, you're the safest person of all because you have natural antibodies. So here's the point. That's how the disease has died out around most of the world, through herd immunity and natural antibodies. Vaccines don't matter. But China, because they have the zero COVID policy, they never had this disease in most of the country. And so they do not have herd immunity. The Chinese do not have the natural antibodies. So now that the Omicron variant has arrived and it's highly contagious, it's spreading everywhere and they have no defense. So except locking down, but China is the world's second largest economy. Shanghai is the largest city in China. Ningbo, which is the port next to Shanghai, is the largest container cargo facility in the world, or one of the 2 or 3 largest in the world. How do you shut that down and not disrupt the world economy? Well, the answer is you can't. It won't accomplish anything. The disease is still spreading. China's very vulnerable because they haven't had it, but at the same time, they're disrupting supply chains. So now we can kind of, so China still has a serious problem. Now to kind of pivot to the supply chain issue, supply chains have been breaking down since really 2018, when Donald Trump began the trade war with China. That started it. It got worse during the pandemic, definitely. But then now we have the war in Ukraine, which is a shooting war, but we also have an economic war involving really the United States and Russia, but also the European Union, UK, Australia, Canada, many other countries have joined in with the United States in imposing these sanctions. I've done quite a bit of work for the government, for the US government, for the intelligence community on sanctions. I've been doing this for 20 years, so I'm very familiar with how they work. We've never seen anything like this. These sanctions are extreme. They're unprecedented, and they will have an impact, but the damage to the United States will be worse than the damage to Russia. The damage around the world will be worse than the damage on basically Russia itself. Now, the Russian people are suffering from this. That's true. Russian financial institutions are disadvantaged. But there's what I call the boomerang effect, where the US throws the sanction at Russia, but it comes back and hits the United States. But not just the United States. It's going to hit Korea, Japan, other manufacturing countries around the world, Germany, et cetera. So we start out by saying we're cutting all the Russian banks out of the global payment system. Okay, that's fine, but they're working on substitutes, and there are exceptions and delayed effective dates and so forth. That's not as extreme as it sounds, although it's unprecedented. But so the United States said no high-tech exports to Russia, no semiconductor exports to Russia. Okay, well, where do semiconductors come from? They're manufactured. How do you manufacture them? Well, you have layers. You need source chemicals and metals to silicon and so forth to form those layers. But then the circuits are etched with a laser, and the laser is powered with a processed neon gas. 70% of the world's supply of the processed neon gas comes from one plant in Odessa in Ukraine. So, and that's under air and soon amphibious assault from the Russians. So we can say no semiconductors for Russia, but Russia can shut down the global semiconductor industry by cutting off exports of the processed neon gas. Think of the things that the world depends on Russia for: platinum, palladium, titanium, to a great extent, aluminum. And that's not even, and so all of those are primary inputs. Korea, for example, Korea has an intermediate role in the supply chain. It's not the biggest consumer in the world. It has a strong economy. It's not the biggest consumer in the world. That would be the United States. It's not the biggest in natural resources in the world. That would be Russia and a few other places. What Korea does is they take the inputs, they're brilliant manufacturing, and then they sell to the world. Well, what if you can't get the inputs? In other words, there's more to the supply chain than just manufacturing and delivery. You have to get those inputs, and many of them come from Russia. So, and not just Korea. I mean, this is true in Japan and a lot of other countries. So you're going to see those inputs disrupted, and then even worse than what I just described, is agriculture. You're going to see a major humanitarian crisis later this year with mass starvation in Africa and the Middle East, because Russia and Ukraine supply about 25% of the world's exports of wheat. Now, that's a big percentage, obviously. If you cut it off from Russia because of sanctions and from Ukraine because of the war, price of wheat is going up. But it's worse than that, because in a lot of countries in Africa, they get 100% of their wheat from Ukraine. Lebanon gets 100%. Sudan gets close to 100%, and so forth. There are 700 million people who live in countries that get more than 50% of their total wheat from either Russia or Ukraine. They're going to starve. And then it gets even worse, because even in the rest of the world, if they have sources of wheat, this is the planting season in the Northern Hemisphere, you need fertilizer. Where's the fertilizer come from? Comes from Russia. So either if you can get it, the price is doubled or tripled, that's going to mean more inflation, or many places you can't get it, which means you can't plant the crops. So your question was a very good one, but I would say the impact on the supply chain is just beginning and it's going to get far worse.
Although there were many expectations that Russian ruble would become relatively worthless due to Western sanctions, and that the Russian economy would soon go into default. However, the ruble returned to its pre-war value. Can you give us some insight as to why this happened and what might be anticipated in the future?
Well, one of the major reasons it happened is because Russia did a very interesting thing. They pegged the value of the ruble to gold by weight. So they said 5,000 rubles equals 1 gram of gold. Now, there happened to be 31.01 grams of gold in a troy ounce. So if you do the math, it comes to about 155,000 rubles to 1 ounce of gold. And then we know from the market that an ounce of gold is worth about $1,950. It fluctuates in dollars, but right now it's around $1,950. So if you divide 155,000 rubles by $1,950, you come out to a dollar ruble exchange rate of about 80 to 1, which is where it was before the war. So what Russia did, they used gold. When you peg the ruble to gold, you're also pegging it to the dollar at the market rate because the dollar is gold has a value measured in dollars. Now there's no peg between the dollar and gold. That definitely fluctuates, but that's going to drive the price of the ruble from now on. So they picked a ruble gold exchange rate that, given the dollar value of gold, effectively pegged the ruble to the dollar at about 80 to 1. And then the central bank is supporting the ruble. A lot of people say, well, you can't really judge the value of the ruble because it's being supported by the central bank. That's nonsense. And every central bank in the world supports their currency. That's what they're there for. I mean, that's one of the jobs of the central bank, is to support the value of the currency. So I don't doubt that the Central Bank of Russia is taking steps, but that's what they're supposed to do. But the key thing was to create the ruble gold peg as a way to support the ruble at about 80 to 1 US dollar. So that was the biggest single thing. By itself, that's more about supporting the ruble than going to a gold standard, but it is a step in the direction of a gold standard. So, and all of these things could ultimately threaten the dollar. I've told clients that the world can probably not destroy the dollar, but the U.S. can do it ourselves. We can destroy our own currency with bad policy, and we seem to be heading down that road.
The world economy is in the grip of a fear of inflation, specifically speaking in regard to the United States. The Fed's big step has been predicted, but is such a response appropriate? If not, what do you think the Fed should do to keep inflation under control?
Well, unfortunately, the only thing the Fed can do to keep inflation under control is to destroy the economy with a very, very severe recession. That's not a good outcome, but that's all they can do. And let me just kind of elaborate on that a little bit. Broadly speaking, there are two sources of inflation. One is called demand pull inflation. That's where consumers just know the prices are going up, so they pull demand forward. They run out, they said, yeah, I was going to buy a refrigerator, but I better buy it today because the price is going to go up next month. Or I was going to buy a new car and I better buy it today because the price is going to go up in 2 months. So there becomes almost a frenzy where people are dumping their dollars to buy things, cars, appliances, land, houses, food, whatever it is, because they fear the price is going up. The other kind of inflation is called cost push inflation. This doesn't come from consumers, it comes from suppliers. It means that basically the cost of all the inputs are going up. Well, that's what we have right now. Right now, you're absolutely right. There is serious inflation in the United States measured in dollars, and it is spreading around the world. But so far, we have cost push inflation. It's coming from the supply side. It's coming from higher energy prices, and that obviously relates to the war in Ukraine. We're going to have higher food prices for the reason I mentioned earlier, which is the price of wheat is going up, the price of fertilizer is going up. And then people don't understand really how complicated the supply chain is. They They look at the factory and the consumer, and they say, well, it goes from the factory to the consumer. But the supply chains are much longer than that. The factory has to get inputs, raw materials, minerals, strategic metals, electricity, wages. And then when you go from the factory to the consumer, you have transportation lanes. So it could be a ship, a plane, a car, a truck. They all use fuel, and the price of fuel is going up, so that higher transportation costs get added to the final cost of goods sold. So this is all coming from the supply side. But here's the point, Gio. The Fed can't do anything about it. I mean, the Fed doesn't drill for oil. The Fed doesn't build ships. The Fed doesn't grow corn. They can't do anything about it. The only thing they can do is to raise interest rates to crush the inflation. So here's the question. How high do interest rates have to go? Well, right now in the United States, inflation is over 8%. It's about 8.5%. Let's just take 8% for a round number. Well, interest rates are 1/4 of 1%, 25 basis points. So the Fed's going to raise 50 basis points, 0.5% in May. They're going to raise another 50 basis points in June. So that'll get interest rates up to 1.25% by the middle of June. But inflation's 8%. How do you stop 8% inflation with 1.25% interest rates? Even if you raise interest rates to 2%, 3%, 4%, you can't stop 8% inflation. How high do interest rates have to go to stop inflation? The answer is 10%, meaning if you have inflation of 8 and interest rates are 10, then the real rate is +2. You have to subtract the inflation from the interest rate to get to the real rate. So a real rate of +2 would probably crush inflation, with one problem. We will be in the most severe recession since the end of World War II, long before that. So the Fed has two choices. They can raise interest rates enough to crush inflation, but they'll destroy the economy. Or they can, in effect, what we say, throw in the towel, like a boxer, you throw in the towel when you quit the fight. They can stop and start to lower rates. That's okay. That might help the stock market, but then the inflation is out of control. So you're definitely going to get more inflation in the short run. The Fed's going to start to raise rates. They will not be able to raise them high enough to stop the inflation without causing a recession. So those are your choices, either high inflation or severe recession. Well, it is a sad story, but part of it is due to US policy. Part of it is due to the sanctions. Part of it is due to the Fed not understanding money. You would think they would, but they don't. They have bad models and bad policymaking.
Yeah. Wall Street perceives low growth as a bigger threat than inflation, raising concerns about stagflation. If there are signs of a recession, is there any way to avoid low growth in the global economy?
Probably not. And so there is something, and you mentioned it, this word came out in the 1970s, but I actually lived through the stagflation, inflation, et cetera, of the 1970s. So I remember, but if you're much younger than I am, you don't. If you're 30 or 40 or even 50 years old, you've never lived through anything like this. But I saw it in the 1970s, and that's when the word stagflation was invented. But it was a combination of stagnation or low growth or recession and inflation. Now, going back to the 1960s, the theory was, well, you can have high inflation with high growth, or you can have low inflation with low growth. But nobody thought that you could have high inflation and low growth. That's what we got. And that's what stagflation is. And we could be headed in that direction. The inflation's already here. So that's people have debated that for a year, but that debate's over. The inflation's here. The question is, how are we on growth? The answer is not very good. The Federal Reserve Bank of Atlanta has a GDP forecasting tool, which is quite good. None of them are perfect, but it's the best one I've seen. As of now, they're projecting first quarter US growth at 1.3%. And of course, the first quarter is over. It's over at March 31st. We'll get the number next week. But their forecast, which is pretty accurate, is 1.3%. That's almost a rounding error away from a recession. So it's weak to begin with. And that was mostly before the war in Ukraine, because the war didn't start till the end of February. The sanctions didn't come on until March. So 2/3 of the first quarter had nothing to do with the war. But now, of course, not only are we in the war, but the sanctions are starting to have a much bigger impact. So I would expect second quarter growth to be even weaker, maybe even negative in the United States. And yet I don't see any end to the inflation for the reason we just mentioned, which is the Fed can't raise interest rates enough. So we may, in fact, get this, what we call stagflation, which is weak growth and high inflation at the same time. And of course, the weak growth will be very bad for stocks.
If stagflation or low growth were to occur, which industries can be identified as strong in crisis? Should we keep going to tech stocks or should we buy value stocks? Which industries would you recommend?
Right. Well, tech stocks have had a great run. We all know about it. And they were big beneficiaries of the pandemic because, at least in the United States, and I believe it was true in South Korea as well, people couldn't go out. I mean, the restaurants were closed, stores were closed. You could stay home and watch, Netflix or some streaming. You could watch movies at home, and you could order online, maybe, but you really couldn't go out at all, and the economy was very much shut down. So we know a lot of businesses that suffered because of that, but who won? Well, the answer is Microsoft, Netflix, Amazon, Google, which they call Alphabet, Facebook, which now is called Meta. They keep changing their names, but those were the stocks that did the best. Well, they no longer have that driver. As I said, with the exception of China, the pandemic's pretty much over. People are going out, they're going to retail, they're going to restaurants, etc. So they don't have that, impetus, if you will. And at the same time, they were very dependent on low interest rates. We had something in the United States in English called TINA, TINA, and that stands for there is no alternative. And that's TINA. And what it meant was that you had to buy the tech stocks because, US Treasury bonds were offering nothing, bank deposits offered nothing. There were no good alternatives. Well, that's not true anymore. The 10-year Treasury note, which is a very safe investment, is yielding almost 3%. That's as much as the dividends on most stocks for stocks that even pay dividends. So there is an alternative. So the combination of higher interest rates, the end of the pandemic, could lead to a very significant tailing off in tech stocks. Now, are there sectors that look interesting? Yes, I would say energy stocks, ExxonMobil, Shell, BP, Total, Chevron, and others. They've been beaten down because of all this, climate alarmism. There's not very good science behind. I mean, climate does change. I used to live on a beautiful body of water 10,000 years ago. It was a glacier, so it changed, but it took 10,000 years. But all this stuff about the world's coming to an end in 10 years, it's all nonsense. We can't get away from oil and natural gas. We can't. Even you can bring in alternatives. I own the largest solar field in New England, non-commercial in New England, my part of the country. So I have a solar field. I know a lot about how they work, but you can't. It's intermittent. I know one thing: it doesn't work at night, and it's not working today because we're having a snowstorm. So the point is, it's what's called intermittent power. Wind is intermittent, solar is intermittent. You cannot run a modern power grid because you need a base of power. You need a baseline of power at all times just to keep the grid functioning, and those things can't supply it. Plus, when you look at developing economies, the demand for energy is rising faster than the alternatives can scale. So sure, there's a role for wind and solar, that's fine, but demand is going up even more. So how do you fill the gap? The answer is oil, natural gas, and uranium if you want to build nuclear power plants. So we can't get away from it. They're going to do well. The stocks have been beaten down. So it's an interesting sector. And of course, I like gold, not all in, but maybe 10% of your investable assets. Real estate will do very well. Farmland will do very well. So even in adverse economic conditions, there are still sectors that will do fine and you can make a lot of money.
Let's talk about investment. You suggested buying gold in an interview last year. When gold prices bottom out, investors who followed your advice should make an 18% profit. Is it worth investing in gold at this point? Or, for example, is it better to buy gold itself or to buy stock in a gold mining company?
Well, it's a good question. The answer is you can do both. Now, when you invest in gold mining stocks, in some ways it's a leveraged bet on gold itself. And what I mean by that is if gold goes up, gold mining stocks can go up a lot more. But if gold goes down, gold mining stocks can go down a lot more. So they're more volatile than the gold itself. So you have to be careful. Don't use too much leverage because you can win big, but you can also lose big. So you have to be careful. And when you look at gold mining stocks, of course, you want to look at the underlying assets. Is the company in exploratory stage? Is it a junior miner or major miner? One of the interesting sectors are what they call junior miners. And the reason is, if they happen to be publicly traded, because they kind of know how much gold is there. They're past the exploratory stage. But often companies like that have difficulty raising capital to exploit the resource. So they get bought out by somebody bigger, Barrick Gold, Newmont Mining, IM Gold, some of the biggest gold companies in the world come along and buy up all these junior miners. So then you can make money not only on the gold, but on a buyout premium from the buyer. And that's attractive. As far as gold itself is concerned, yeah, it's going to do very well because the dollar, I'll use dollars, but you can think of this in any currency. The dollar price of gold is simply the inverse to the strength of the dollar. If there's a weak dollar, the dollar price of gold goes up. If there's a strong dollar, the dollar price of gold goes down. Well, in addition to gold stocks, you can invest in physical gold yourself directly. And I do recommend that, not too much. I'm certainly an advocate for having gold, but people think I would put, 50% or 100%, and that's not right. You should never put that much into any one asset class. But I think 10% is an appropriate amount. So maybe 10% in physical gold, something in gold mining stocks, and then there are many other things, including cash and some of the things we mentioned, such as energy companies and agriculture land and some others.
I'm well aware of your views on Chinese companies as the possibility of delisting Chinese companies within the U.S. stock market increases. Chinese regulators are showing a forward-looking appearance, such as expanding the disclosure of company information. Investment in Chinese companies is higher than investment in U.S. companies this year. What is your outlook? Do you still maintain your previous held view in regard to Chinese companies?
Yeah, I'm very bearish on Chinese companies, Julio. And when you mention delisting, it is true that the United States is putting some pressure on Chinese companies to improve their disclosure. Now, I would say they never should have received exemptions in the first place, but leaving that aside, we're now at the stage where the U.S. is requiring them to disclose more, higher disclosure standards, more similar to what U.S. companies themselves have to do. But there's also a move to delist that's not coming from the United States, it's coming from China. The Chinese, remember, they're not driven by the market, they're driven by the Communist Party. The Communist Party is actually fearful of the power of some of these Chinese oligarchs and Chinese companies. We know all the big names, Tencent, Alibaba, Ant, and many others. And so the Chinese are saying, well, you have to delist from New York and list in Hong Kong Stock Exchange, because Hong Kong is now, their independence is gone, their freedom is gone, they're completely under the thumb of the communists. So you're seeing pressure from both sides. The US is sort of pushing them out because they don't meet the disclosure standards, but China's saying you have to get out and come to Hong Kong. So it's all part of the bigger trend, which is the decoupling of the US and Chinese economies. It won't happen overnight. It's a multi-year process, but it is underway. And I would say on the US side, it's driven by national security. And on the Chinese side, it's driven by a desire to maintain a Communist Party control. So, but that aside, even if you took the Chinese companies independently, leaving aside the delisting issue, which we just discussed, the outlook for China is extremely negative. And demographically, they're going to have the greatest demographic calamity or collapse in the history of the world. They're going to lose 600 million people over the next 40 years. And that's because their population is aging. The one-child policy has been extremely damaging. 20 million or more girls were killed at birth. And so, and even today, even though they relaxed the one-child policy officially, no one cares. People say, well, we're not getting married. We want education. We want to go to the cities. Marriage rates are down. Birth rates are way down. The replacement rate for any population is 2.1, meaning each couple or each childbearing woman has to have 2.1 children in order to maintain. That's just to maintain the population constant. If you're below 2.1, your population is shrinking. China may be as low as 1. That's catastrophic. That's not a small difference. That's a huge difference. It'll cut the population in half in within 2 generations. So a lot of their technology is stolen, so that's being cut off. They cannot steal as much technology as they used to. The population is aging, and the productivity of older people goes down. Aging is highly correlated with dementia, Parkinson's disease, Alzheimer's disease. A lot of people are going to be devoted to the care of the elderly, which is a worthy thing to do, but it's not. Giving people a bath hasn't changed in 5,000 years. That's not an occupation that lends itself to productivity gains. So, and China has no natural resources, or at least very few. So it's so demographically, industrially, quality point of view, and financially and otherwise, China is going to go into a very steep long-term decline.
In the last interview, you said that a stock market correction would come from the fall in October this previous year. Your prediction was correct, although the stock market correction has been prolonged due to uncertainty. There are reports that Wall Street recommends buying. When do you expect that adjustment period to end? Should we follow the Wall Street recommendation?
You should never follow Wall Street recommendations because they actually don't care about you. They only care about themselves. Common sense plays a role. There are independent financial advisors who can help people who are not, in the brokerage industry per se. There are some good economists, not very many necessarily, but there are some good ones. But what I would say is, and I'm more of a macro analyst than a technician, but we have completed what technical analysts know as a head and shoulders formation. So head and shoulders is, the stock market goes up and it goes down a little bit. Then it goes up to all-time highs, and then it goes down. And it goes up again, but it doesn't get as high as the time before. So it's here, higher, and then back up, but not as high. And then it goes down a lot. If you look at a chart, we've completed the head and shoulders formation. So we're now in a pattern of a downtrend, lower highs and lower lows. That's just the trend. That's how bear markets look. But it's more dangerous than that. It's more vulnerable than that for the reasons we talked about earlier, which are supply chain sourcing, the impact of the war, humanitarian crises, transportation, logistics disruptions, higher interest rates, many other factors, Chinese shutdowns, et cetera. So I would expect that decline to accelerate. So we're in a downtrend. Nothing goes in a straight line. It doesn't go straight down. There'll be up days and down days, but the trend is downward. Which doesn't mean you can't be in stocks, but you just have to be very selective. And above all, I would recommend allocations to other types of assets. So I would include cash, land, gold. If you're in the stock market, energy stocks, I think will do well. And really just construct a portfolio with things that are not correlated to each other. I see people who they say, I'm highly diversified. I have 50 stocks in 10 different sectors. And I say to them, you're not diversified. You may have 50 stocks, but you have one asset class called stocks, and they will all go down together. So get some other asset classes, including, as I say, natural resources, gold, cash, land, farmland, and some other sectors. Well, it's always gradual at first and then sudden. So right now we're still in the gradual stage, but watch, I wouldn't expect a sharp downturn until maybe late this year, early next year, meaning late 2022, early 2023, because the Fed is raising rates, but they're kind of doing it slowly. The supply chain is breaking down, but it also doesn't all break down at once. The impact of the sanctions takes a while to kick in. So all the factors that we've discussed will have a very negative impact on stocks, but not right away. It'll be a downtrend, but I would expect perhaps a more severe turn of events in the fall, maybe October.
In conclusion, there have been multiple and overlapping negative factors this year: inflation, rising interest rates, and geopolitical crisis. What advice would you give to investors in the current situation?
Number one advice is diversification, which we just talked about. So have some stocks, have some cash, natural resources, gold, real estate, farmland, maybe some treasury notes, because we remember if the economy really collapses, we could have deflation instead of inflation, and you want to be ready for that. So number one, diversification. Number two, have some liquidity, have a larger than normal allocation to cash, maybe even 30%, because you won't get hurt in a downturn. And when the downturn comes, you'll be able to go out and buy some bargains. Other people will be stuck in losing positions or things they can't get out of, but the person with cash can go around and buy up things at a deep discount. By the way, the number one person in the world who's good at what I just described is Warren Buffett. Warren Buffett has record amounts of cash because he can see this coming also.
오늘 글로벌 구루에게 듣는다 제임스 리카즈 씨와 이야기 나눠봤습니다. 리카즈 씨는 주식시장이 베어마켓, 즉 약세장에 진입했고 올해 말에는 이런 현상이 더욱 심화될 것이라고 판단했는데요. 투자 전략을 더 다각도로 고민해야 할 때인 것 같습니다. 함께해 주신 여러분 고맙습니다.